Welcome to our annual funds conference, Clear Direction. I'm delighted to see a full hall of people. I'm very much looking forward to spending an interesting and hopefully enjoyable afternoon with you. It's my job to get us going, so I'm going to kick off the proceedings. But before I do that, I think it's very important that I acknowledge the contribution of our sponsors. This is one of London's largest funds conferences, and we couldn't put this kind of thing on at this scale without the contribution of commercial partners. So I'd like to acknowledge the contribution of Kerry Olsen, Channel Islands Stock Exchange, Walkers, Whitmill Trust, Moore Stevens, Pavilion, Altair and BNP Paribas. Thank you very much for sponsoring and contributing to our conference. We very much appreciate it. And also our exhibitors downstairs, Kerry Olsen, Crestbridge, JP Morgan and Moronto Zanz. And finally, our media partners, Funds Europe, HFM Week, Prequin and Unquote. Thank you for helping us promote the conference and fill the hall today. I'm here to talk to you about economics and the alternate funds industry. The experts are going to talk to you about politics. And to borrow the old Clinton campaigning phrase, I don't know if they're using it again now, it's the economy stupid. So if you take the global recession, we're still around the world creating wealth. We've moved through the crisis years. We're seeing global growth, wealth creation, and we're seeing the need for investment return around the world. Of course, the shape is changing. The size and share of global economy is moving eastward. You can see this is a chart by Angus Maddison. Charts the share of global GDP over the many hundreds of years, almost a millennia, and you can see the resurgence of China and India. But growth is still there. This is the Economist Intelligence Unit's forecast for 2016. I suspect this has been moderated a little because of the market gyrations in the early part of the year, which incidentally I think probably have helped the hedge fund, macro and CT industry quite a lot. But nonetheless, 2.5% growth, looking realistic. America's still going very strongly, above trend growth still in Asia, Africa, etc. So wherever growth takes place in GDP, we've got wealth creation, we've got activity, we've got the opportunity to buy and sell and target assets. But there are risks around, and we're very cognizant of them. And I think it's very important to be risk aware when you're setting out with your investment and market priorities. Of course, there are transition risks. China moving from an investment-led to a consumer-led economy, that's a very big transition. It's a planned transition, but there are some bumps in the road. Lower energy prices. We've seen the effect on the oil-producing nations and some concern about those who finance them and their financial stability. And of course, we've seen the nervousness around US rate adjustments. So there are some things to be watching and be concerned about. I've touched on Brexit already. That could be a very big bump in the road, yet to be seen. We've got the EU tax packages coming through. I've called this BEPS+++, because Europe tends to overlay a little bit extra on whatever's going on. So there could be a little bit of extra layer on the BEPS programme. We wait to see. Not too worried in Jersey. We're a governance-led substance jurisdiction. We're not into interaction of DTAs and cross-border base erosion, so I don't think it's going to affect us too much, but it's yet to be seen. And of course then EU instability, it can resurge at any time. We've got Greece still simmering in the background, and we've got other issues around the Eurozone, and of course there's the major migration issue at the moment, and then the major event shocks that you cannot really plan for or foresee. Our view is that the USA should lead the developed countries still with strong fundamentals, that we think that the recovery is so well embedded there that the current market confidence doesn't reflect the economic underlying fundamentals. We believe the UK should weather the headwinds subject to Brexit, and we believe that in time, lower energy costs will feed through into the real economy. If you, as a business, are consuming far less, you're consuming energy, but consuming at a much lower cost, and as a private individual, that's got to feed its way into consumption in the real economy at some stage. I believe China worries look a little overdone. $3 trillion of reserves, interest rates that can actually come down quite away from where they are, the option to loosen bank lending and to start to look at things like QE mean that they've got an awful lot in the locker to deal with their transition issues. And of course, India's resurgence at the moment, 6-7% growth under the Modi government, still got its challenges in terms of liberalisation, but nonetheless doing fairly well. But even if you accept the world's a slightly unstable place, that drives business to safe harbours. And I think London and Jersey meet that criteria. stable, rule of law, politically stable, fiscally stable, deep pools of broad expertise. These are things that international investors look for, and I think their attractions are magnified in times of uncertainty. And of course, worldwide wealth and cross-border investment will continue to increase. So let's look at the alternates world. End of 2015, 4.2 trillion AUM in the private capital space. I've used the pre-Quinn definition, which I think is quite helpful. If I just read that to you, it's private equity, private debt, private real estate infrastructure, and natural resources. So capital going into real stuff. Reached an all-time high in 2015. Another $551 billion raised. Dry powder up 7%, and unrealized profits in portfolio value up 3.8%. So actually a very strong period for private capital. The situation doesn't look too different for alternates. Alternates have had a difficult couple of years prior to 15, but came back strongly. 3.2 trillion AUM, 71.5 billion raised, and 134 net new funds launched. So 829 gross, 695 close. So still growing as an asset class with more than 5,000 institutional investors. So quite a buoyant period for the alternates industry, and something that we felt in Jersey with record levels of business being seen. What's driving that? Well, it's not a cyclical driver, it's a structural and fundamental driver. So the rush into alternates isn't a short-term momentum trade. It's about a disillusionment with traditional asset classes. It's about evolution in state-of-the-art portfolio construction, the sheer financial alchemy now, the sheer competence of managing complex assets has developed so far that many more people now can look at alternates as a realistic asset class. And the other two big drivers, the need for absolute return rather than benchmark failure. And the biggest of all, I think, is the hard-to-close pensions asset liability gap. We have record numbers of people retiring around the world, the baby boomer generation. They're expecting their pensions, and pension funds are very hard pressed to deliver those returns, which is why you're seeing compound growth in alternates of about 10% versus traditional asset classes of about 5%. That fundamental structural driver will continue. So what's happening in Jersey? Well, over the last 18 months, our alternates AUM increased in the regulated space to $334 billion. That's up 15%. The number of funds increased, and interestingly, the number of promoters using jurisdiction has increased dramatically, up 113% over the last 5 years. And our private equity as a subsector of alternates growing around 40% over the same period. What's driving that? It's the commitment of major brands to Jersey because the platform works for them, and it's the success underpinned by reputation and a commitment to proportionate regulation. Major brands have become very concerned about reputation in the world, and they want to associate with financial centres that have a good record for sound governance, for sound reputation, for sound regulation, and centres that are up with the programme. And I think Jersey qualifies in terms of all of that criteria. Just looking at hedge as an asset class, 7 years ago, we started coming to London, talking to the hedge fund community. At that time, we had 3 hedge fund managers in Jersey. Today, we have 23. We took the liberty of taking some pre-Quinn figures and interposing our own EUM into them. As you can see, if you look at some along the names along the foot of that graph, Jersey now is becoming quite a significant hedge fund centre in global terms. So why is that? Why are these major brands investing? Well, just have a look at some of them. And I think it is all about governance and substance. If you are a major global brand, you want to associate with a set of brand values that are going to reflect your own, that you do business right, you do it in the right way. So here are some of the brands that have either entered Jersey or grown their physical footprint in the last 18 months or so. As you can see, you have some of the largest PE houses, asset managers, and hedge funds in the world. It wouldn't be apposite, perhaps, not to touch on at least the AIFMD Funds Directive. I'm sure you're all heartily fed up of talking about it. We've been talking about it for years. But I think it's important to tell you where we are with it. Jersey is one of only 3 countries in the world that is effectively passport ready. So we have our AIFMD approval, should a passport emerge. But we have the assurance of national private placement regimes too. So we literally have the best of both worlds. And our MPPR regimes are being used very heavily. Why have we achieved that status almost uniquely? Because we've demonstrated third country equivalence. Whatever checkbox you want to tick, whether it's transparency, whether it's regulation, whether it's AML performance, whether it's governance and the pool of NEDs and management reach, we are amongst the best in the world and can match up to anybody, and particularly in the European Union. Now, regulation is still a big feature of our world. I'm not going to go through this chart. You'll be highly relieved to hear. And we're going to have BEPS covered under the panels. I'm sure that might just lead into the EU tax package, which is really an outcome of it. I did just want to mention Moneyval. That name may not be familiar to you all, but this is the body responsible for testing the application of the FATF rules in Europe. We just recently had our review from Moneyval. I haven't seen the official report yet, but talking to regulatory colleagues, and we have one of them on the panels today, they told me it's going to be a very good report and amongst the best issued to date. So it's so important that we keep performing in that area so that you can have the comfort. If you book business in Jersey, you know it's soundly regulated and approved at the highest standards. I think the same is true of transparency, and that hopefully will come out of the panel too. So we're an early adopter on the Common Reporting Standard. We're collecting information in 2016. We're exchanging in 2017. We're in that early wave again of people embracing information exchange and transparency. We've been fully supportive of the BEPS programme. We're currently consulting on country-by-country reporting, and it's my expectation we'll be an early adopter and early implementer of that programme. We continue to be a world leader in beneficial ownership capture and information exchange. We have a corporate registry that captures beneficial ownership, and all of our corporate service providers have to capture that information and be able to provide it to our authorities on demand, speedily and readily. In respect to comparisons of other countries, that is actually a world-class position. So, looking ahead, what are we doing at the moment? Hopefully that's laid out the economic backdrop for you. It's laid out the positioning of alternates generally where we are. What are we planning on doing next? Well, we're actually reviewing our funds regime as we speak. We're not looking at revolution, but we are looking at incremental evolution. And our criteria is to continue to give you certainty, speed and simplicity, so that if you deal with Jersey, you know where you stand, you know when your fund's going to get authorised, and you know what the outcomes are going to be. And the objective is to simplify whilst maintaining our competitive edge, and to streamline our authorisation purposes whilst continuing to meet or exceed international standards. Now, you'll recollect perhaps in 2013 that Jersey commissioned a study called Value to Britain. It was undertaken by Capital Economics, and the study uncovered the fact that we support 180,000 jobs in the United Kingdom. We generate 2.3 billion in net tax receipts and around 9 billion of GDP. And we bring 500 billion of foreign direct investment into the United Kingdom, principally from capital sourced from outside of the European Union. That's 5% of Britain's entire FDI stocks. What that did is prove to the British government that we're actually a net additive. We're a contributor to the British economy, and we want to do the same for the European economy. So we have commissioned a similar style of research. We'll refresh the Value to Britain work, and we will show, I think, quite demonstrably what our role is in contributing to the European jobs and growth agenda, which I think will further reinforce our very strong and good relationships with the European Union countries. So that is it from me in terms of getting our conference going. I'm going to introduce our first keynote speaker now.